Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is October 16th, 2024. We're here with renowned econ professor Edwin T. Burton from the University of Virginia. Professor, a lot's happened here in the last 30 days. The Fed on September 18th lowered the target rate 50 basis points. On that Monday, September 16th, you came out adamant that the Fed had to lower rates 50 basis points. How did you know they were going to do that?
Just by watching the Treasury bill market. If you keep an eye on the Treasury bill market, particularly the very short-term Treasury bills, the Federal Reserve can't do its own targeting very different than what those bill yields are, because the federal funds or repo market, either one, are essentially the same credit as a Treasury bill. In other words, they're very similar securities. So if Treasury bill yields start falling, the Federal Reserve will soon follow. And the same happens going the other way. When people worry about the Federal Reserve raising rates, they're typically just following the increase in yields that you see in the T-bill market. Now, right now, for example, if you look at the 3-month Treasury bills, they're trading around 460. That's a number below the current federal funds target range, which is 4.75 to 5. If that pulls the 2 and 1 month down below 4.75, then they will cut by 25 basis points in the upcoming November meeting. So far, it's not clear whether they do that or not, because the 1 month and 2 month T-bills are in their range. They haven't dropped below their range. I think they will drop below their range. So my best guess here is that they will lower the federal funds target another 25 basis points down into the 4.5 to 3/4 neighborhood. That might not happen for sure, but we will know within another week or so. Just watch the 1 and 2 month T-bill yields. If they get below 4.75, then there's no question the Fed will cut by 25 basis points. There's no indication they're likely to do the larger size, the 50 basis points, because that would require T-bill yields to drop below 4.5, and they're not even close to that right now. So if you were guessing about November, you would currently guess that they'll drop their target 25 basis points. But in reality, Fed isn't doing anything. The market has already made this move, and if the market continues to make this move, the Federal Reserve will follow it. The Federal Reserve is not a leader. It's a follower.
Brings the question, Professor, why lower rates when the economy's strong, stock market, U.S. stock market is at all-time high? Why lower rates?
That's a great question. In macroeconomics courses across the country, if you wandered into one, what you'd learn about macroeconomics is that Federal Reserve policy is the following. When the economy is really strong and you have a lot of inflation, then you raise rates. When the economy is really weak and you want to spur the economy, you lower rates. What do we have now? We have a very strong economy. It's growing above trend, and they're lowering rates. Wait a minute. I thought they lowered rates to stimulate an economy. Is this an economy you want to stimulate? You've got growth above the long-term trend, and you've got the stock market at an all-time high. Is now the time to be lowering rates and make this get even crazier? A simpler explanation is that the Fed is not guided by how strong the economy is or the rate of inflation or anything else. They're guided by the simple fact that the rate that they control is essentially the same credit as T-bill yields, and they're simply following the T-bill yield market. So if T-bill yields fall, then the Federal Reserve cuts its target range, independent of whether the economy is growing strong, fast, unemployment is going up, down. It really doesn't make any difference. But why is that surprising? If you wanted to analyze the value of peanuts, the first thing you'd think about is what's the supply and demand for peanuts. That's the last thing most economists think about when they want to know the value of a dollar. All you have to do is look at the supply and demand. The supply went up 50%. The demand hardly went up at all. So imagine a product where the supply goes up 50% almost overnight, and demand doesn't go up at all. I would bet, and I think anybody over the age of 8 would also bet that the value of whatever that is that went up in supply is going to drop in value. And that's what inflation is. It's a drop in the value of the money supply. And that's what happened. And who caused that, by the way? The Federal Reserve itself. You want to point the finger at who caused the inflation? They increased the money supply 50% over 16 months, from 14 trillion to 22 trillion, 14.5 trillion to 22 trillion, from early 2020 to March of 2022. That's unprecedented. That has never happened in the history of the country, ever. It's never happened. And guess what happened when they did that? Inflation started and continued. And inflation is now taking the price level up about 30%. It's probably got a little bit more to go. There'll probably be another 5 to 10% increase in the price level. It kind of explains why this is a bifurcated period of economic growth. If you're in the upper incomes and upper wealth stratum, you're doing great. Oh my goodness, your stocks are roaring, the big homes you have, your second homes are all flying in price. But if you don't have a whole lot of assets and you're fighting to make ends meet every week, and you go to the grocery store and the gas pump and look at your rent and look at the insurance costs and look at healthcare costs, you start looking at all those things, you're getting obliterated. It's not so much the fact that the price level is going up at 2% or 10% or whatever it is. It's that it's so high that it's gone up 30% essentially over 2 years. Unless your wages have gone up 30%, you have lost a lot of ground. And so you have half the country, actually more than half the country, suffering economically. There's no question that the working folks with very few assets are suffering in this country. But on the other hand, if you spend your days at the country club and playing golf and living the high life, you've never had it so good. At home, you've had doubled in value over the last 2 or 3 years. And the stock market, the Dow Jones was 6,000 in March of 2009, 6,000. It's 43,000 today, 7 times as high. You've never had it so good. That's pretty good. So you've got some people in the country doing great, and most people in the country are suffering.
The Federal Reserve a month ago lowered the target rate. Many U.S. citizens are dismayed that their mortgage rates are going higher. Can you speak to the mortgages are priced probably off the U.S. 10-year? The U.S. 10-year, when the Federal Reserve lowered the target range so approximately a month ago, was 3.69%. Today it's 31 basis points higher. Mortgage rates are not going lower.
In fact, mortgage rates are significantly higher. Just before they lowered their target range for the overnight repo and federal funds market, just before they did that, the 30-year fixed-rate mortgage was trading in the neighborhood of 610 to 620. This morning it's 665, I think, somewhere in that area. Mortgage rates have gone up a lot. And so if you wanted to know why does a 10-year Treasury, which is roughly the same duration as mortgages, because mortgages are amortized, they're paid off over time. You don't make a big principal payment at the end. So the typical duration is much lower than 30 years if you look at the payments. Why would those rates go up? They went up because the 10-year went up. Mortgage rates tend to follow the 10-year Treasury. So the question now is, why did the 10-year Treasury yield go up? What made it go up when the very short-term rates were all crashing? And the answer is, guess what? Supply and demand. There was record corporate bond offerings the last 2 weeks. As people rushed to the market to try to capture some of these yields, that put huge pressure on the 10-year. Why? Because when Wall Street is doing financing in the corporate market, they hedge it in the 10-year. They sell 10-year treasuries. And when you start selling treasuries, guess what? Their yields start going up because their prices are going down. So what happened was you had a lot of supply, a lot of people wanting to borrow more money. And so the government is competing with other borrowers. And when you get a whole lot more borrowers in the market, the government has to pay a higher yield. And that means mortgage rates go up as well. So it's all part and parcel of just supply and demand. The demand for loanable funds went through the roof the last 2 or 3 weeks. And that took all 10-year yields up, whether it's mortgages, 10-year treasuries, corporate bond yields, anywhere you look. Rates out in the 10-year and on out to the 30-year spectrum went up. And nothing much happened in the very short end because the short end had already gone down. The Fed was just following T-bill yields down. So the T-bill yields we're looking at today are about where they were before the Fed acted. The Fed just brought their own target range in line with what the market had already done. The lesson to be learned from this is that the market determines rates. Now, the Fed can do it. The Fed can determine rates, but they have to use the balance sheet to do it. One simple way to do it is the next time there's a 10-year auction, the Fed can come in and buy the whole thing and print money to buy it. They can do that. They can keep those rates from going up. Be a little embarrassing because they have to report their balance sheet all the time. So they're not likely to do that. But the Fed can't wave a magic wand and say, have rates go here or there. That's just not possible. They're not the Wizard of Oz. Or maybe they are the Wizard of Oz. You know, when Dorothy was watching the Wizard of Oz, she snuck up and saw him behind the big curtain. At first, she believed he could do all these things, just like Americans believe the Federal Reserve can do all these things with interest rates. But sooner or later, Dorothy saw the truth. She realized the wizard couldn't do these things. And someday, Americans will realize the same thing about the Federal Reserve. They're just following the events. They're not really leading them. The truth is, when you see a price go up or down, think of the forces that would determine price go up or go down. If car prices aren't going up, which right now they're not, why? Because car demand is off. If car demand starts roaring, car prices will go up. If the demand for corn starts going up, prices of corn will go up. If the supply of corn expands, prices of corn will go down. And the same thing is true of literally everything. Rates are inching up because the demand for loanable funds is inching up. That's why it's happening. With nothing to do with Jay Powell's probably watching TV or off having fun on the golf course or something. He's pretty irrelevant to the rise in mortgage rates.
The Fed has purchased a significant number of treasuries over the last 5 years. Are they subject to the same profit loss that everybody else is?
Well, the Federal Reserve has historically always made money. It's nice when you have a printing press. It's kind of you're not really completely stupid. And if you're borrowing money at a zero rate and lending it at a higher rate, you're probably going to do all right. And so the Fed has traditionally made a lot of money. I would too if you would loan me an infinite amount of money at zero interest rate. I think I could figure out how to make that work. But when the Fed embarked on buying all those treasuries, that $7.5 trillion increase in the money supply in 21 and 22, they decided they would buy a lot of mortgage-backed. And at one point, they owned 25% of all the mortgage-backed securities. That kept mortgages low, probably too low. This is back in 2021. So they've made one mistake after another. You know, they have a big balance sheet. They can do things without consulting Congress. They can spend $7.5 trillion without even talking to Congress. But they ended up buying a lot of 30-year treasuries and mortgage backs. And guess how they did? They got slaughtered. So the Fed's been losing money. They've lost several $100 billion each of the last couple of years. And they're on track to lose more. They don't always mark themselves to market. You and I have to. So they sometimes don't tell everybody exactly where they are. But if you remember Silicon Valley Bank that went bankrupt out in California, remember that one, Hunter? Well, think of the Fed as Silicon Valley Bank. They bought many of the same issues, and they lost a lot of money. We're talking hundreds of billions of dollars. We're not talking a few million. The Fed went out. They wanted to keep mortgage rates low. I'm not sure why. I'm not sure why they thought keeping mortgage rates at 3% was such a great idea. But that's what they wanted to do, and they managed to. If you've got a big buyer who's not interest rate sensitive, who doesn't care what they pay for something, the market can't work. And so the Fed intervened dramatically in the mortgage market to the tune of owning ultimately 25% of all the mortgage backs. And now they're unloading them. Guess what that does? That pushes mortgage rates even higher. So the Federal Reserve, by now reducing its balance sheets, going the other way, they're a player that is destabilizing. Someday people will realize that the Federal Reserve, far from calming the country or calming the economy, is introducing instability all the time. They keep rates too low when they enter the market with their balance sheet, as they did in 21 and 22. And now they're reducing the balance sheet, but not by very much. But the change has had an effect on these yields. So the Fed itself is the main cause of all the high rates that we've experienced. It's the main cause of inflation. If you're going to have 9% inflation, believe me, you're not going to be able to have 0% interest rates. The market took those interest rates up, not the Federal Reserve. That's probably the biggest mistake that I think most commentators, you watch Wall Street, you watch CNBC, you watch all the analysts, and what do they tell you? I've been following Jay Powell around, and guess what he's thinking? It doesn't really matter what he's thinking. If you want to know what the next rate cut's going to be, watch the T-bill market. Forget about Jay Powell. Forget about the Federal Reserve. Just watch the T-bill yields.
Professor, can you speak to rent controls? There's some counties in the United States are asking their state legislatures for permission to mandate rent controls. Good thing, bad thing, what's the net effect of rent controls?
Well, it's interesting. A lot of policies sound really good if you don't think them out. And imagine saying, oh, these people can't pay $2,000 a month for rent. I'm going to help them out. I'm going to mandate that nobody can rent to anybody for more than $800 a month. That'll help that one person if you can get them in there, or whoever's looking to do it today. But it'll mean no one wants to build rental housing anymore. If you want to see how wonderful rent control is, why not go to New York City and try to rent an apartment in Manhattan? A studio in terrible shape starts at $4,000 a month. How do you like that? $4,000 a month for a studio apartment. They have great rent control in New York. They have rent control, rent stabilized. But go up on Park Avenue in the 80s. Go into one of those doorman buildings. You'll find people living in whole floors paying $500 a month. Now, wait a minute. How does that happen? How does people having big, giant apartments rent them for $450 a month or $500? Because they've kept them in rent control. Their great-grandmother had them, and they passed them from generation to generation. They're rich enough to be able to do all this. So rent control is great for rich people. If you really want rich people to be subsidized, but if you want to freeze all the poor people out of your community, start adopting rent control. Within a few years, no person of limited means will be able to afford anything. Try renting something in New York today. If you're really dying to see rent control in action, a lot of folks maybe listening to this broadcast probably have children that work in Wall Street or something. They've had the experience of trying to find an apartment in Manhattan. It's an unbelievable situation. You have to pile 3 and 4 kids into an apartment, a one-bedroom apartment that runs, $7,000 a month, and they split it all up. They share one bathroom. It's inconceivable how they live. You can bring that to the whole country if you just adopt rent control everywhere.
Do you have former students living in rent control apartments in New York?
Now, one of my students recently, her aunt has been protecting this one rent-controlled apartment, big, beautiful apartment on Park Avenue. So she got in for $500 a month. It's a wonderful deal. Meanwhile, somebody who doesn't have the connections, doesn't have a wealthy aunt who's managed to hang on to it, somebody with just normal means, so they're trying to figure out how to shoehole 3 people into an apartment, a studio apartment that rents at $4,000 a month. Things like this always favor rich people. If you think you're helping poor people by having minimum wage laws or rent controls or price controls, the minute you put a maximum price on something, people quit producing it. Suppose whatever your business is, somebody came in and said, from now on, you can't do that business at a price higher than whatever. You're stuck. Let's go to some economist who works at a university somewhere. Suppose we go to him and say, hey, you're making $150,000, $200,000 a year being a professor. Let's lower that to $30,000. Yeah, it's not fair that you charge $150,000, $200,000. We're going to make it $30,000. You think there'll be a big increase in grad students wanting to become professors? If you want to kill an industry, put rent control. So if you want low-income people to have no housing at all, if you want to absolutely freeze them out of your community, adopt rent controls. That's the best way to get poor people to be forced to move to Nelson County or to some other county somewhere where they don't have rent controls. That's what people do. And if you don't believe it, go take a trip to Manhattan. You'll see.
Professor, you're the best of the best. We need to do a podcast next week in preparation for November 7th when the Fed meets again. And we're all anxiously awaiting your prediction on what the Fed will do.
Keep your eye on the Treasury bill market, as I know you do, Hunter, and you'll know before I know, probably.
Thank you, Professor. Thank you.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.